Hey guys, and welcome to another episode of the Finance Troll. I'm Matt, your chieftain, here to help you get out of that cave. Now let's talk today about the power of finance math. So some of you have heard the term dividends, some of you have heard the term reinvesting. What are we going to do? Let's talk through what a dividend is, how to choose a dividend stock, and the time value of money. So there is some powerful math out there called compounding interest. And the old rule of thumb is if you don't know what it is, it's because you're paying it. So the idea is to flip the switch and actually you start becoming and compounding your interest and your math and your money. So without further ado, let's see what we're talking about here when it comes to dividends and reinvesting your money. So introduction, stock market 103. One is about dividends. There are two other videos on my channel. One is about general finance as far as how much should you allocate to funds, how much should you allocate to each stock class. And stock 102 is about finding those stocks and classes and bonds and ETFs using Charles Schwab. So if you have not watched those yet, I would recommend watching them. And either way, if you're just curious about dividends and compounding interest and math, let's get into it. So number one, learning how to compound interest, how compound interest works and how you can harness it. Who needs to know this? To me, the younger you are, the more important this is. Your 401k today is more important than anything you will ever have because people usually leave it alone and that will compound on its own. By the time you retire, you can reap the benefits of starting early on a 401k or a savings plan for retirement. The power of dividends is that you can reinvest that money, the free money that the company gives you, into more shares, which then gives you more money, and on and on and on until 30 years down the road, you have more money than you started with if you had only just invested in the stock market. So the math is very simple, and I'll show you that. But again, learning this is one of the most important things you do the earlier you are. If you're 20 years old, 23 years old watching this, is very important. Even if you're 35 years old. Every year that goes by is tons of money that you could be missing out on. So what is compound interest? These are the returns that can create returns. So this exponentially moves up. So you've seen the hockey stick chart before. That hockey stick part that points to the moon, that's the last like 5 years. So the first 15, 20 years doesn't look as impressive. So again, the longer you can invest and reinvest, the better your returns will be. The example here, if you have $200 a month invested for your entire life, and you just every month you invest $200 in some kind of a dividends, just regular 8%, you're going to be $47,000 at 10 years. Doesn't seem like a lot of money, right? Like that's not that good. 30 years though, I mean, it's more than quadrupled into $245,000. Adding in dividends into this will make this even better. Introducing dividends. What is a dividend? So a dividend is a cash payment you will receive from your company that you've invested in. They give this money to their shareholders. Why do they do this? Sometimes it's to attract more investors to a boring business. AT&T has a cable company and a phone company. That is a boring business. There's not much you can innovate with that. But every single month, you pay your cell phone bill and your utility bill, and they get the money every single month. So if you have a steady income stream, you can then turn around and say, hey, shareholders, in order to make our stock a little bit more enticing and more exciting, here you go. We're giving you a percentage, 4%, 5% of what a value of our stock is every quarter to help you come to us and invest. Some stocks or REITs, which are real estate investment trusts, they are required by law to give a certain amount of their income out. I can't remember exactly what it is. You can look it up. I don't even want to say it. But every quarter, they are going to give a higher dividend than normal because that is what is required. They have to reinvest their money in assets. And if they don't spend all their money they made, they've got to give it out as a dividend. Steadier the income, the steadier the dividend will be. So if you have a company, again, that is just rock solid, and there's examples at the end of this that I can show. If they have steady income, they make the same amount of money pretty much every year, they're going to give that dividend, it will be a steady dividend. A 4% annual dividend on $10,000 is an extra $400 a year. Again, doesn't sound like a lot, but over 30 years of reinvesting that, it really starts to add up. So you want companies that can give a steady dividend because then you can rely on this kind of compounding chart. So here's $5,000 a month start with $200 per month, 30 years at a 3 to 7% dividend. So you've got your various forms here. Again, what I was saying, like halfway point, your 5,000 is in like the 60,000 range, and these are two different things. This is 7%, 5%, and 3%, you're only like tripled your money or whatever by then, right? But the real power comes on year like 25 to 30. And if this goes 30 to 40 years, so say again, you're 20 years old and you're looking to go, when you're 60 years old, if you're 20 years old looking for 70 years old, this gets even crazier. I mean, you're talking about $1 million probably by the time. So again, the power comes in the last 10% of whatever you're looking at for a time frame. I cannot stress that enough. How do you choose a dividend fund or a stock? So there's a bunch of different numbers that you need to pay close attention to if you're going to find a dividend stock or fund. The yield obviously is the most important part, right? So if you look on Schwab and you find a stock that pays a dividend, it will say on there a yield, 3%, 2%, 8%, whatever it is. That is yearly. So if you want to figure out how much money you're going to get each quarter, which is how often they get paid, you divide that by 4. So 8% every quarter is going to be 2% of whatever the total amount you have invested in. Or they will tell you it's this many cents per share, right, or whatever. So it's a $100 stock, it's a 5% dividend, you're getting 50 cents per share, you own 10 shares, that's $50. So it's very simple math that way. So if it's per share, it's how many shares you own times that. Or if it's a percentage, you can take your total amount. Say you got a mutual fund and you got $10,000 in there, multiply that by the dividend. The payout ratio is another very important thing, and this is kind of tougher to find. Some people will report it. Sometimes you got to kind of dig a little bit, especially for real estate stocks. It varies, but the payout ratio is how sustainable is a dividend fund compared to their income. So if your payout ratio is 65%, that means that out of the total amount of income per share that they make, they're paying 65% of it, right? So if they're making $1 per share in income and their dividend is, 65 cents, I mean they're paying 65% of their income out as dividends. Any less, any more than that gets a little bit sketchy. Some stuff gets, so when real estate got crazy in 2022, those real estate funds were like 106%. Not sustainable, right? They're paying more money than they were making because everything got so high and they had to keep up. So you want to be below 65%, and dividend growth is important. You can look at their historic dividend growth, and is the company raising their dividends, lowering their dividends? Have they had a crazy high one? They had to cut it like crazy. What happened back then? Will it happen again? You need to research some of these companies, right? So I think some of these utility companies pride themselves on every single month the dividend has gone up like 1 cent, right? So not only is your money compounding because you've been reinvesting your dividends, but also the dividend is increasing. And now the stock is increasing, right? When you first started buying the stock, it was at $15. Now it's at $37. So your shares are increasing. So again, the time power of money is not only money for you, but money for the company that you're investing in, making sure you've got good financials, good payout ratios, and is there a dividend growth that you can rely on. Examples here, Coca-Cola, Johnson & Johnson, AT&T, all very stout, good dividend companies. Real estate companies, there's a bunch of good ones on there. I actually recommend a couple different things on Motley Fool. There's a couple good people on there that you can research, and they will tell you some of their favorite real estate funds, some of their favorite dividend stocks, some of the lesser known small cap stuff. If you want to get something that's more like a 7 or 8% dividend, right? You're kind of like, I'm younger, I've got some time to mess around a little bit. I don't want a 2.5% Johnson & Johnson dividend. I want the 8%, WPC, which is a real estate company. I want their dividend, right? Like real estate down for the year, interest rates are up. I want to take advantage of that. I want to buy these real estate stocks when they're low, and then not only will the dividend help me, the share price will recover. So some of that. You want to get even further down the rabbit hole, there are very high risk dividend funds that do things like leverage. They do high yield, like option contracts. They're called yield max is their main product. They'll take a company like NVIDIA, sell calls, and then you're pretty much buying the underlying of that. It's a whole thing, but they can pay out 6-7% per month, not per year. Do your own due diligence. Do not just buy this stuff because of me. I am not a licensed broker. However, there's some really cool stuff out there if you really start going down the train of I want to do dividends, I want to reinvest, and I want this to work for me. So again, there's plenty of stuff out there. And I think my next video will get into finding some of that stuff. Building your portfolio, how much dividend exposure is too much? Depends on your age and goals, right? So if you're putting all of your money into dividend stocks, that is a very safe, easy stock portfolio to have, right? It's very low risk. There is still risk. There's risk with anything in the stock market that the prices could go down, but you're not getting the upside. I mean, if you're talking about a small cap stock, some new company that's got growth and no dividend, their stock could go up 200%. You could triple your money. You could quadruple your money. You invest in AT&T or 3M, you're going to get 10% growth, like maybe, if you're lucky, and then still potential downside. So there is pluses and minuses. You don't want to get too much dividend stock. But if you have the time, again, there's other products that you can look at to maximize the compounding. Bonds are another good one that's like 4 to 5% right now. You really do the calculation on compounding that money over 30 years. That's going to be a sizable chunk of change when you're ready to retire or whatever the case is. And again, you should also be compounding the amount of money that your portfolio is making. Taking money out of the stock market, while important if you need it, it's a long-term game because it compounds. Refer to my other video if you want to find the stocks or use the stock screener on Charles Schwab, which is what I use. But most people recommend about 75% to stocks, 20% to bonds and dividends. Always keep some cash in case the stock market goes down and you have some dry powder. That's what some people recognize. Call your local stockbroker or CPA if you want more financial assistance. But this is the general rule of thumb. So with that, we are done with our dividends. If you have any thoughts or comments, drop them below. If you like the video, subscribe. We will constantly be coming out with more financial stuff, some stock one-on-ones. And I think it's important for you guys to get a good base of operations. Don't listen to the gurus. Don't listen to, there is no way to get rich quick in this business. Quick as death. And you want a quick death? Follow those guys. You want something sustainable and growth? You come to me, Finance Troll. I got your back. Until next time, guys.